considering the last 3-4 years of fiscal policy and monetary policy and the valuation levels, we suspect that for the indexes, it's going to be a tough year. For active managers, I can get back to that later, we're actually pretty encouraged.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. On this channel, we often highlight abnormalities that we notice in the financial markets. Well, today's guest actively embraces them as gifts from the investment gods. In his words, fortunately, the financial markets are often quite inefficient, presenting opportunities for us to generate substantial value for our clients' portfolios. So, where does he see the biggest inefficiencies in markets today, and what opportunities are they presenting? To find out, we've got the great fortune to speak today with highly respected money manager Dave Iben, Chief Investment Officer, Managing Member, Founder, and Chairman of the Board of Kopernik Global Investors, as well as Portfolio Manager of its main funds. Kopernik manages billions in client capital. Dave, thanks so much for joining us today.
Well, thank you. It's great to be here, and Happy New Year to you and everybody.
Thank you. Happy New Year to you. And I've got to give a quick shout out here at the start to our mutual friend, Stephanie Pomboy, who made the introduction for me to reach out to you. Dave, I got to tell you, Stephanie, one of the most wonderful and just smartest analysts I know. And she said that, Adam, you've definitely got to interview Dave Iben. He is hands down the most brilliant analyst I know of. So I'm so grateful she did. I'm sorry to set such a high bar of expectations at the start of this interview, but I think Stephanie was being very genuine.
Well, I'm a big fan of hers. She did set the bar way too high, but she's very nice and I appreciate it. And I agree with you. She is one of the smartest people I know out there. I always look forward to talking with her and reading her great research.
Yeah, well, all right. Well, you and I and virtually everybody watching this video are huge Stephanie Pomboy fans for very good reason. All right, Dave. Well, look, super excited to get to know you through this discussion we're about to have. If we can, I'd like to kick it off with the very intentionally general question I like to start these conversations with. What's your current assessment of the global economy and financial markets?
All right, let me start with the disclaimer that we are 100% bottom up. So my top-down views are worth exactly what you're paying for them.
Okay.
But we do look at history, we do look at valuations, we look at what is currently happening in the world and see where that leads us. And it's clear to us that one, the U.S. market is almost the most expensive it's ever been on almost any metric versus the size of GDP or replacement value or book value or sales and earnings when calculated right. All these things suggest the U.S. market is going to be difficult to sustain at these levels. The rest of the markets, not so much so. We can come back to that. As far as the economy, that's interesting because it is doing what it's doing. Some people think it's pretty strong. Some people think we're actually in a recession. What we do know is it's where it is despite in the U.S. alone, $2 trillion worth of deficit spending every year. And most other countries are maybe not to that extent, but also deficit spending. So the economy is artificially strong versus whatever any fundamental backing it is. And maybe we're in the early process of rediscovering that debt is not a free lunch as the interest costs start to pick up. So, considering the last 3-4 years of fiscal policy and monetary policy and the valuation levels, we suspect that for the indexes, it's going to be a tough year. For active managers, I can get back to that later, we're actually pretty encouraged.
All right. So thank you for doing what an interviewer always wants is getting the punchline in there, which is you think it's going to be a tough year, presumably relative to the past 2 years that we've had, right? That were 20+% years for investors. Pretty much a buy anything and hold it and you're going to do fine type of year. As you mentioned, your firm is a bottoms up firm. And so I guess that really does make you guys active managers, right? You guys are out there looking for the underpriced assets, the assets where the market is somehow not fully recognizing what you consider to be their true value. I've got to imagine it's probably been hard of late. And correct me if this is a wrong assumption, but I've got to imagine it's been probably hard of late in this environment where kind of the tide was rising, everything, things were artificially stimulated, as you've been mentioning here. Valuations are the most expensive they've ever been. So I imagine the set of trying to find undervalued assets is probably smaller than it normally is. A, is that true? And B, it sounds like from your opening remarks here, you think both our economic growth rates are going to be difficult to sustain, but also market valuations will probably be difficult to sustain, at least in the aggregate. And if that's true, I guess, are you expecting some sort of correction? And if so, then does that begin to make your job easier as a bottoms-up active manager because that starts revealing better and better valuations?
Yeah, I mean, it's gets easier as it seems harder.
Yeah.
John Marie Everard, I'm a big fan of. He says value investing is pain, and the higher the level of pain, the better future performance is going to be. Let's see. You worked a lot of stuff into that question.
I did. Sorry.
Yes, we are an active manager. Matter of fact, 70 some odd percent of our stocks are not in the index, I think, which is a rare thing nowadays. You said it's buy anything and hold. Yes and no. Yeah, 2021 was more buy anything and hold. But back in the late 60s, everything started to fall except for the Nifty 50 when it went up. That was the only thing you wanted to hold. In the late 90s, everything, all the value stocks started to fall. It was only the TMT that was going up. And this year, famously, you pretty much just wanted to hold the Magnificent Seven,
Kevin.
or maybe the top 100 stocks in the S&P 500, because the U.S., not counting those, wasn't up that much. The world wasn't up that much at all. There are, I think, saw for the 15 countries, major countries, their markets were down last year. And actually, as an active manager, that's what we want. We like it when it starts to break down.
Yeah.
Indexing is predicated on the fact that the market's efficient. People do their research. The index mimics what everybody's doing. But you get times like the 70s and the 90s and now where the whole premise breaks down. People are buying indexes. Nobody's doing research. The index starts to outperform everything that it's supposed to represent. And to your point, that is a very, very painful time to be a value investor. It always breaks down. It must. Yeah. And so when 72 broke down, that's say where Capital Group became Capital Group because they stuck to their knitting and value worked great after not working in the 60s. For me personally, the late 90s were painful. And then the next dozen years were almost too good to be true as that gap went from one extreme to another. And times like now, where the Magnificent Seven is up 67% or something, and 2 years up 250%, why many markets were down. That's what we want, because we are actually finding not just relative, but in absolute sense, very, very cheap stocks around the globe. And so this is the point. I think maximum pain for value, but I think that sows the seeds for what should be a nice time for active managers.
Okay, so yeah, maximum pain per value as we have this distortion that you just described. Presumably, as it turns into maximum pain for growth, maximum pain for however you want to describe it, that will start to become the future salad days for value investors like yourself.
Yeah, I mean, you don't wish bad on anybody, but it was the momentum stocks that created tremendous pain when the 72 broke and when 99 broke. And I suspect momentum stocks have gotten to things where the fundamental foundation is way below the current price. So quite likely it won't be a good time for momentum.
Okay.
I would have said that
Um,
a year ago. So,
right. The big question, obviously, is when, right? Yeah.
yeah,
All right. So, uh, to find value today, it sounds like you've had to kind of go outside of the indices, right? You said 70% of your stocks that Kopernik currently holds are not in the index. It also, from your comments, sounds like you're going outside of the U.S. as well.
yeah,
Um, uh, Emerging markets have definitely been disappointing in recent years, and understandably so, given both the momentum stocks you talked about and the pull of U.S. capital markets. I mean, you're right in the sense that market cap wise, we've never seen, I don't believe, so much concentration into so few stocks here in the U.S. In terms of investors being long stocks, like their percentage long, were near all-time highs, if not at them, even scarily in like senior citizens. Their equity exposure is the highest it's ever been.
right.
So everyone in the U.S. is in the same pool. There's these small number of stocks, and the rest of the world, the U.S. Stock market cap is the greatest percentage of total global market cap, equity-wise, that it's ever been. So kind of the whole world is concentrated in just these very few number of stocks. Um, so I guess let me ask you this: you have a good understanding of when we've sort of seen this movie before. What kind of scale of correction do you think we'll see if indeed history repeats here and the momentum stocks fall out of favor and things start to right size? Is this
Yeah.
going to be a small, medium, or severe correction?
It could be pretty tough, but let's put that into perspective. I think to your point, the U.S. is, I think it's what, almost 75% of the world index right now,
Mhm.
2/3 of the all country world index. That's pretty big for something that's 20 to 25% of the economy. So, uh, there's all these articles now about U.S. exceptionalism. Yeah, we agree. The U.S. is pretty exceptional, and there's a lot of things to love about it. And I love it. I've lived here my whole life. People forget about price. And so if we were sitting here almost 100 years ago in 1929, somebody could have said, the U.S. is sort of a leader in radio and in autos and assembly lines, and our future is great. The next 100 years, we are going to be maybe the best empire in the history of the world. They would have been exactly right. They would have lost 90% of their money over the next 3 years in the stock market.
Mhm.
It's all about price. And in 1972, people said the U.S. is great, and companies like Coca-Cola and Johnson and Johnson and Procter and Gamble and IBM are companies that are just so good that price doesn't matter. And all these years later, 50 years later, most of them you're actually looking pretty good. But 2 years later, you had lost 3/4 of your money. A matter of fact, 10 years later, when I came into the business, I'm like, wow, how come Coca-Cola and Procter and Gamble are so cheap? And it's like, well, because their earnings went up for 10 years, and the stocks dropped for 10 years, and they're very, very cheap. 99, same thing. Cisco, you were right about the company, but still haven't broken even on the stock. Eventually, you ended up way ahead on Microsoft and Amazon, but first you had to endure 80, 90% drops. And
Mhm.
so, yeah, maybe that's where we are in the Magnificent Seven. They are clearly great companies. So maybe 50 years ago, people were saying, I'm glad I bought it, but I wish I would have got out before the 75% correction. Yeah, and maybe that happens, maybe it doesn't. But uh, I can't predict the future, but I would say a 29 crash is unlikely. 90% drop. We're not on a gold standard now. We're not anything close to a gold standard. I would suspect it would be more like the 1970s, where it dropped and came back, but over 10 years, the market went nowhere. But since there was no gold standard and the Fed printed and printed and printed, and you had inflation rates in double digit for a lot of those years, in real terms, you had lost 50 to 75% of your money in most of those stocks. And I imagine now that the Fed's made it clear they do not want deflation. They do not want stocks to drop. And so
Mhm.
I would guess that they will be in there as they did a few years ago when a couple banks got into trouble. They printed a lot of money, and before that, when when there was a flu bug going around, they print $4 trillion, and I would suspect that it'll be a long, drawn out inflationary thing. But once again, I'm not top down. The important thing, though, is not even so much whether I'm right or wrong about that. It's that there are way better investments people can make. And so, yeah, if you in the 1970s owned Schlumberger and Exxon and Homestake Mining, you made a lot of money when people were getting killed. If you owned Japan, I think John Templeton had like 40% of his portfolio in Japan. It went straight up while the market was getting killed. And I would suggest now people should spend less time worrying about whether I'm right or wrong about what happens to U.S. momentum stocks and spend more time thinking, where is the real money going to be made? And that is, I think, in good companies that are very, very, very cheap because people don't like them because they're not in the index, or they don't like them because they're in a sector they don't like, or they don't like them because they're in a country they don't like, or a region they don't like. That's where we're excited.
Okay, great. So you're taking the conversation exactly where I wanted to, which is, it sounds like you don't necessarily, can't rule it out, but you're not necessarily thinking we're going to have a crash at the 1929 scale, but we could have a lost decade or more, right? Or maybe something in the middle there.
Yep.
If we do get some losses in the markets, you expect the central planners to use the modern playbook to step in and intervene and rescue and further distort things. And who knows what'll happen there? Although I guess the thing that we can have the most confidence in is that the purchasing power of the currency is going to pay the price.
Mm-hmm.
So the question I was going to ask you, as you were giving all that context, was okay, well, then how does one invest in this type of environment? Sounds like you've just given your playbook for this. So at Kopernik, how is your team going out there and saying, okay, like how do we find these great values that are likely going to uh, either buck the trend if there's a correction in the market, or just such deep values right now that over time they're gonna clearly be good returns.
Yeah, I mean, it's more of the latter. If bonds are paying 4 or 5%, and we're finding stocks that are half price and will double, question comes up all the time, what's your catalyst? And we say, well, the bad news is we don't have a catalyst. We just know the fundamentals argue for a doubling. And if the doubling happens in a year, well, I'll be happy. 100% returns are pretty good. But
Mhm.
if it takes 2 years, you're talking 41% a year. 3 years, it's 26%, something like that. If you have to wait 7 years, which is a lot longer than you usually have to wait, you're still making double-digit returns. And so we tell people we're going to buy things that are trading at 50 cents on the dollar, 25 cents on the dollar, and wait a year or two or six or whatever, and that will work out. And then on that note, we can take, say, Verizon and AT&T. What's not to like? They're good companies, triopolists. They have a product that people would, they'd rather give up food than give up their cell phone service, I think.
Mhm.
And so, we like them just fine. But then we look around and say, well, what if we want to buy Vodafone in the UK, or we want to buy Korea Telecom or U Plus in Korea, things like that? Well, we're also getting triopolists. We're also getting companies with this very same cell phone service. The Koreans have as good a technology as anybody, so we've got that. And we're getting it maybe a little better price to earnings, but way better in terms of price to book, price to customer, price, dividends, you name it, and way, way better on book because Verizon and AT&T don't have tangible book anymore, that sort of thing. And so if we can get the same quality overseas, and then we generally give it a 30% haircut because it's overseas, we're still getting it at a big, big discount. Yeah, we used to years ago on a lot of the U.S. railroads. They were hated. Now they're pretty much loved, and a lot of reasons to love them. But if we buy railroads in Japan or in Hong Kong, then we get the same good fundamentals, but we get big discounts. We're buying these things at book value and, you know, discounts to book value and low PEs. And so that's pretty interesting. Or in the US, people correctly value cheap, clean, carbon-free electricity. And so you can pay up for nuclear or hydro in the US. And why not? Except for we can buy things at 75% off if we're buying the hydroelectricity in Brazil, or we're buying the nuclear power in China, places like that. And so I can go on and on and on. Almost every industry, we can buy what we think are similar quality companies at half price, 25% of the price, better. And so that is roughly half the portfolio is just same quality, but because the index is all in the US, we get it cheaper. And then we can go in more. Then I can go, the second part is sort of this free optionality we're getting on real assets.
All right, I want to talk about that in just a second, but let me stick with the first part. So the logic makes total sense to me. Let's find kind of a varsity grade business model in the US, and then let's try to see if we can't find that exact same model in other countries where we can get it at a much better value, much greater discount. So I'm sure there's more factors than this, but there's two big risks when you do that. One is currency risk. And the US dollar has been quite strong as of late. And I guess as that continues, that, maybe it gives you better entry prices in some of these things. But if you bought it, you're having you're paying that currency differential. Now, if you think the US dollar is sort of at an extreme, like some of the other things we talked about, and you think that we might start having a weakening dollar, well, then that would add a tailwind to these investments, correct?
Correct. And picking currencies is tough. I mean, I think a lot of smart people lost money shorting the yen for like 20 years before the yen finally got around to falling in half. But I think that took a couple of decades to happen. And yeah, everybody was sure back in 2008, 9, 10 that because the US was at the root of the financial crisis and was printing money, that the US dollar had to plunge. And the crowd, when they all agree on something, are almost always wrong. And the US dollar has been going straight up for the last, 15, 17 years. Now, everybody loves the US dollar, or maybe it's in a left-handed way of it's the cleanest dirty shirt is what they'll say. But, but people in recent years have been saying, all right, so we're doing this massive QE and printing trillions of dollars out of thin air. And more importantly, we're running $2 trillion deficits every year. And even the government admits they expect that to increase over time. Yeah, everybody seemed to know that's bad for the dollar, and yet the dollar keeps going up. And so people have thrown in the towel, and everybody loves the dollar now. I would suggest there's a high likelihood they're wrong. Once everybody's all in, that's usually it. To your point, though, two things I'd like to say. One, yes, if it reverts, then this underperformance you've seen in international for a lot of years will revert. And you can go back and look at many decades of history. US outperforms for a few decades, underperforms for a few, outperforms for a few, underperforms for a few. And so it's probably more than due for the dollar to fall, and with it, the performance of U.S. stocks should be falling. So that's likely, but timing, who knows? The other thing, though,
Sorry to interrupt, just so you can include this in your answer.
Yeah.
When you are making the decision to purchase these international assets, are you baking a currency expectation into that decision, or is it more just like almost like a warrant that would come for free? Like, hey, if this thing ever has some value in the future, great. If the currency exchange goes in our favor in the future, great. But it's not part of our core reason for buying this.
Yeah, we have a little bit of all. It's interesting. Stocks, in our opinion, are different than bonds. And so if I buy a bond in Europe, I can hedge the euro and I've locked it in. I'm going to get the returns I expect. But you cannot do that with a stock. With a stock, nobody's promised you anything. And so I think that I've hedged euros back to dollars, but what I've really done is just transferred the risk of the euro falling to the risk of the dollar falling. And so unless you know the future and unless somebody's guaranteed you that your earnings expectation 5 years from now are correct, you cannot hedge stocks. So we throw all that out and say back to square one. What is a stock? A stock is ownership in a business. And so we are owners of businesses, not players of stocks. And so if the business I happen to own is, say, Inpex in Japan, and it's got oil and gas, those trade in dollars. And so if the yen drops, sitting here in the US, theoretically I've lost money, but I haven't because they're selling in dollars. And so their profits are going to double and the stock will double in Japan and I've lost nothing. So I have no need to fear the currency. And if I own Toyota, we don't, but if I own Toyota, same thing, not quite as concrete, but they produce all over the world, they sell all over the world. Dropping yen will not hurt them when they're not in Japan. It'll probably help their sales from what they make in Japan because it can cost competitive. And so big global conglomerates, not so much of a problem. If we own the railroads, which we do, we say, well, if the yen were to fall in half and we've lost half our money, railroads have a good franchise. Theoretically, they should be able to double their prices, but they won't be able to because the regulators will say no, and the clients will push back. And so maybe they can only push half of that through over time. And so then we say we've lost money. That's a risk to us. So hedge, but like I said, you can't hedge because if we think we put a hedge on and the yen doubles, then we've lost money playing currencies. So we do not hedge, but we don't not pay attention to the risk. And so we say we want a big margin of safety. So we'll take a 40% margin of safety or a 50% margin of safety just to compensate for the fact that yes, the yen can hurt us. If we're talking a utility in Japan, if they are importing natural gas and the yen falls in half, they're buying in dollars, so their cost just doubled.
Mm-hmm.
So we lost half our money on the currency, and now their costs have doubled, and their revenues maybe go up 50%. So now they're losing money, and so there we want a huge margin of safety, and hence we don't own them. That sort of maybe a longer answer than you wanted, but it's a very complicated subject, foreign currencies.
No, I appreciate it. What we're trying to do is give the audience transparency into how a money manager like you thinks about making allocations. So actually, this is very, very useful. One other question about risk, and then we'll get to your point on real assets. So that was currency risk. Obviously, another big risk when you invest internationally is country risk, right? Now, most of the countries I heard you use as examples were developed countries, England, South Korea, et cetera, although you did mention China. How much time do you guys spend sweating the country risk side of things?
A fair amount. It's mandatory on every stock that's in the portfolio. But one thing we like about active management, we think, and when the markets sometimes think, and other times they all just follow the crowd. And when people start saying binary things like US good, emerging markets bad, that's really flawed because people view emerging markets as a small, volatile, risky place. We say it's not small. It is almost the entire world in terms of people, in terms of land, in terms of countries. It is most of the world. And so because somebody's lumped it in a thing, if somebody sells their emerging market fund, they might think that they're selling Venezuela, but they're really selling Korea. Korea FTSE, and we agree with you, it's developed, but MSCI calls it emerging markets, and so it's an emerging market, and therefore it's risky. And so we believe a phone company in Korea is not very risky, whereas a grocery store in Venezuela is probably quite risky. And so To count them together makes no sense. But even in Europe, you see, people liked all Europe, and then was it a dozen years ago, four of them they decided to call pigs, and they fell. The Portugal and Italy and Greece and Spain, they wouldn't hold them at any price, and then they rallied back big again. And so to lump them all together doesn't make a lot of sense. And so for every company we have, we say, all right, well, what are our risks? Bad management, bad balance sheet, geopolitics. Let's consider all these things. And then we'll say, is it that bad a country? What is their history with capitalism? What's their history with good technology, good governance, that sort of thing? And rather than say it's 0 or 10 on a scale to 10, we tend to give a lot of these things 4s and 5s and 6s, meaning we demand a margin of safety that's half off. And then we buy it when the market sells it cheaper than that. But absolutely, we spend a lot of time focusing on countries, and even within the countries, the risk to owning a regulated utility might be a lot higher than on owning an oil company, that sort of thing.
Mm-hmm. Okay, great. Well, that's super helpful. Thank you. All right, so you had just finished your part one when I interjected with those risk comments. Your part two was going to be, I think, your approach to investing in real assets.
Yeah, and there's a lot of interesting stuff there. I mean, we always bore people with this guy from 300 years ago, Richard Cantillon. He knew John Law and the whole Mississippi scheme. He managed to come out of it all making money, but he wrote this thesis saying, sure, the monetarists are right that printing money is inflationary, but it is non-neutral, was his word. It's not like you double the money supply and everything doubles in price. He has this concept of a river. Like if you poured a massive amount of water into the Mississippi River up in St. Paul, people in St. Louis wouldn't know about it for a few days, and people in New Orleans wouldn't know about it for a long time. And so different times, and it would come rolling in waves and things. And so history will show that when you print money, it tends to go into the bond market, and then it goes into the stock market. And so you get a bond bull market and a stock bull market. And then when they get expensive, it starts to go into real estate. And when real estate gets expensive, people start to build houses, and then lumber prices start to go up, and carpenters' wages go up, and then the local coffee shop can charge more, and it kind of goes through the system. And so yeah, now it's kind of interesting. You've got, whenever the Fed prints money now, people are like Pavlov's dog, oh, they're printing money, let's buy stocks and bonds. But that works until it doesn't. It worked in the 1920s until it didn't in the 1930s, and in the 90s and whatever. It works till it doesn't work. And so maybe we're there. One of these times they're going to print money and stocks will go up for a day or two and say, hey, there's already no oxygen up here, and come down. But more importantly than that, it migrates, and it tends to move one thing after another. And so we've seen this volatility, and that's another key. We're always told volatility is risk. Volatility is not risk unless you have a lot of big mortgage loan, or margin loan, or short-term time horizon. If something is at 10 and it's going to go to 20 and it has a brief stop at 5 first, that's great. You get to buy more at 5, and that's a great thing as an investor. And so as all this money printing, we've seen it had a massive run into certain stocks in 2021. Then those stocks corrected in 22, and then they're going back up again now. And so if you were going to buy, say, Meta, it made a lot more sense to do it 2 years ago than 3 years ago, that sort of thing. And so it goes through the system, and that creates lots of opportunities. But as it's going through the system, it eventually gets into the real economy. It always has, anyhow, in the past. And so eventually you see the price of copper and gold and uranium and oil and other things start to go up. Also, other countries too. And so we found this interesting. So they announced they're printing a lot of money in 2020. Of course, it pouring into the bond market, but it also running into the gold market. And while gold was going up, the price of copper and oil and uranium and natural gas were plunging because everybody was sure we're going into a depression. And so that allowed us to take a lot of profits in gold and move it in all those other commodities. What is a mere year later, I think everybody changed their mind from depression to boom times forever. So they sold gold like crazy. Who needs gold during boom times? And ran ran oil up to 100, and so then we sold our oil and went back into gold. And so these waves of money coming through, everything going higher, but at different rates and different times is an opportunity. Also sticking with gold, we like it, but gold for years and years traded a discount to platinum. Now, platinum, if the price were to go up 2.5 times tomorrow, it would still be trading cheaper than gold. And so, yeah, that we like to take advantage of these things. A few years ago, gold's better than palladium or platinum. Now platinum's better than gold. I already talked about copper, or uranium was interesting. It was $137 back in 2007. It hit 18 7 or 8 years back, and it clearly couldn't stay there. Nobody was going to build a mine for for prices that weren't multiples of that. So that was an opportunity to buy that. Then what was it, a year ago or less? The price had gone from 18 to 108, and everybody loved uranium all of a sudden. Then it dropped to 68, and so now it's a much more attractive opportunity. So we believe that this money printing has taken its time going through the system. Also, the fact that they're running $2 trillion deficits increases the likelihood of more money printing. I think that's one thing that everybody agrees with. And then as it migrates through the system, why not take advantage and buy things for $68 that were trading at 108 not long ago with uranium? Why not buy, oil down and $20, or why not buy platinum at 40% less than 40% of the price of gold, that sort of thing. And then one last point, and this whole thing's not moving together like this. Price of gold basically at an all-time high. That's above the ground at your corner coin store. Gold under the ground, trading on Wall Street or Bay Street, is trading at, I think, a 65% discount to where it was when gold was back to 1800s. I mean, so gold's gone up 50, 60%, and the GDXJ has gone down 60 some odd percent. And so that's a divergence. Is it deserved? Partially, yes, but a lot of it, no. A lot of it, no. And so we say if somebody wants to sell us gold for $1,000, we'll take it. And so all these are extremes of the people. People think fine on their own, but as part of crowds can really swing things, and that's what makes it exciting to be an active investor.
Well, that's where the opportunity lies, right? That's where quoted you from the beginning, right? Financial markets are often quite inefficient that present the opportunities. To your point there about how cheap the miners are relatively to the gold medal, an analyst that comes on this program from time to time, a precious metals mining analyst, Jeff Clark, just issued a piece talking about how gold in the ground is dirt cheap, and playing off of that term dirt cheap, he compared on a price per ton basis the in-ground reserves of a lot of different mining stocks versus the current market prices per ton of soil, mulch, and compost. And actually, the gold in the ground was trading at a lower price per ton than those dirt equivalents.
Yeah, that's great. I'll have to look for that.
Yeah.
And then, one other thing, I won't go into the detail because it made it get kind of boring, but not only is gold in the ground cheaper, but gold that's long live reserves. If you have 20 years worth of reserves, that should be way better than having 5 years worth of reserves. But the way the market prices it, because they flip upside down their discounting cash flow model, they do it the opposite of every other industry. And people they can look at our website on the boring details. But the exciting part is that the best reserves, the long-lived ones, are the ones that they think are worth nothing. And so it's cheap underground and gets cheaper the longer the live reserve is. It's a real quirk in the system.
That's funny. It's like, to a certain extent, it's like discounting reserves in a bank vault less over time. Yeah.
Pretty much, yeah.
Yeah. Oh, wow. Okay. So, all right. One question off of that I want to dig into, but thank you for walking through that methodology. Super interesting. When we talk about this river of liquidity, you mentioned the tremendous surge that we saw during COVID, but money is still going into that river, right? From the deficit spending that you mentioned and some other things that happen, like, draining of the reverse repo facility and things like that. Um, uh, do you do you see sort of, it's the right way to say this. Is the money, as it's trickling into the real asset part of the economy here now, is that flow diminishing, you think, as time goes on, or still rising as time goes on?
Yeah, there's people that are way smarter or more attuned to me on this thing, but it does sound like they've done this clever job of unwinding the reverse repos and the excess money, and so they've made it look like they've been shrinking the money supply when in fact they haven't. And to my understanding, depending on who you talk to, we're getting to the end of that game. And so sometime in the near term, either they need to resume printing, or there's going to be some repercussions to the market, or maybe it's both. Maybe the market starts to fall and then they come print, but they can't keep draining these reserves forever. They're running out of these games, I think.
Well, so if the flows start diminishing, I was thinking about it from the commodity, the hard asset part of the world. Presumably, as those flows diminish, some of these big swings to the upside would theoretically diminish because the upward pressure isn't there. But if we think about it like this river, would we expect the bond market to suffer first and then stocks before the corrections happen in the real asset world?
Good question. I know the answer, but maybe you're seeing the answer now because bonds are already suffering.
Yeah.
Yeah, it's interesting to see bonds dropping most days while stocks just go straight up into it. So yeah, it might be likelihood. If they're not going to start printing more money, who's going to buy the bonds to finance these $2 trillion? So bonds arguably are showing right now that they're first.
Okay. So that's making me want to go to my next question, which is still kind of a high level macro question. Before I get there, though, just so we can put a big bow on your bottoms up view of the world. Okay, so we're now starting in 2025. We've had 2 exceptional years in the markets. A lot of people are expecting for a three-peat here, right? We got a lot of market euphoria in there. We've got valuations at, in many cases, all-time highs, as you started off this conversation with. As a bottoms-up value-based investor, are you kind of licking your chops here? Like, hey, I think everybody's going to be really disappointed, and this is going to be a great year for our type of methodology. Or do you have a different feeling coming into this year?
It is interesting that was a little over a year ago. Everybody, I can't remember what the odds of recession were. They were pretty high.
I mean, coming into 2023, I don't know if I knew of an analyst who didn't think we were going imminently into recession.
Yeah, and then it didn't happen. And I saw a poll, I think it was yesterday, like 34 economists, 0 said we're going to have a recession this year. Yeah, so they were wrong last year. Are they going to be wrong again? I mean, it is interesting how people can all be bearish, and then the stock market goes up 30%, or the Nasdaq anyhow. And now people are completely bullish after that. So I don't know, but licking our chops. I mean, value investors, we like to worry. It's just what we do. But
Hmm.
I will tell you, a good friend of mine I used to work with back in '99. We had a bet for a beer. I lost, fortunately, but he was saying, "My God, our stocks are so cheap. We're going to do great." And I said, "The Nasdaq's going to crash, and when it falls 80%, we'll only be down 30%." He's like, "No, we'll
Hmm.
be up." And we bet, and sure enough, the next 3 years, the Nasdaq fell 81%, and we were up 60%. We were up 27 the first year because our stocks were so cheap. But then in 2008, we lost money, not as much as everybody else, but we lost money. Uh, I would optimistically say that everything was expensive in 2007, where this is more like '99, where people are paying a fortune for what they love and they are giving away. Our entire portfolio is trading for less than book value. I remember 11 times earnings. It's unbelievably cheap. And so I, uh, I like to think that our stocks are so cheap they'll go up, but if there's a big crash, who knows? So we're optimistic, but we are anything but cocky about that.
Okay,
We'll
got
see.
it. But of course, even if it just stays flat, zero is a pretty great return if the market is, in free fall, and folks got a taste of that in 2022, although it's not that they seem to have any recent memory of
Uh,
that.
once again, they were rewarded for buying the dip.
Yeah, yeah. Well, let me ask you this last question before I get to the big macro one. So if you are expecting a rougher year a disappointing year in the markets for the general investment community, and I know you're not necessarily predicting, a big crash. Even a single-digit year would be disappointing to the investment community. Um, but if you thought that lower prices were in store at some point in time for the indices, at least, um, uh, one might say, okay, well, we're going to reserve part of our portfolio just in kind of dry capital, right? If we
Mhm.
believe there's going to be better valuations in the future, let's keep some in reserve for that. Um, is is that factoring at all into your strategy for 2025, or are you guys just pretty much always like, look, if we just find something that's we think undervalued enough, we're just going to buy it, and we're going to just trust that over time, value will find its true price?
Yeah. And I'll spare you our process for now, but as things get cheaper, we buy more, and when they're going up, we trim a little bit. And so
Yeah.
our cash balance tends to go up when markets are rising, but we don't get our crystal ball out there and say we expect things to crash. Uh, yeah, what do I know on the U.S. market? But usually, when you have momentum like this, I would say a 9% drop is probably not what happens. Once momentum breaks, it breaks.
Hmm.
So that could be a lot worse. But I just can't stress enough that people should not confuse somewhere between 7 and 70 stocks in the U.S. with the world. And so last year, while the market was up big, Korea was down 21%. Brazil and Mexico were both down around 30%. I think I mentioned earlier there's been 15 countries around that were down. Uh, and our portfolio tends to be good companies that are oligopolies or huge asset owners, and the thing is trading at less than book value. And so, uh, the economy will do fine or it won't do fine. But when we're buying good companies that cheap, we're going to buy them. And hopefully they go up next month. But if the market corrects and it takes us a couple of years to double our money or longer, we'll do that. We would rather have a short-term loss and double our money than miss the double because we thought we knew how to time a market. And you won't find a portfolio as cheap as ours very, very often. So the aberration is a handful of stocks in the U.S. Other than that, the stock market's not bad.
Okay. So yeah, kind of a value picker stock market if you ignore, the top 7 to 70 US stocks.
Yeah, which we get to do.
Yeah. Yeah. Okay, super interesting. One question I forgot to ask too. I'm throwing all these questions in before my last one here. Um, we've talked a lot about stocks. We've only mentioned bonds, showing that the bond market's beginning to show some signs of displeasure. Roughly, how does your portfolio break down between equities and bonds?
100% equities. We're an equity manager. There have been times like 2002 and 2008 where we put 20% in bonds because we were getting 15-20% yield for strong balance sheets, but we tend to we're most part of our mandates equities, but also I've been doing this 43 years. I ran bonds for 5 years. I'm old enough to remember 22% interest rates. I remember treasuries with double-digit returns. I remember getting junk spreads that were 800 to 2,000, and so to me, 0% interest rates was an abomination. It just should never have happened. And when rates went up to 2 or 3, I guess the whole generation of people thought these are high rates. To me, these were pitiful rates. 5, 6, 7. Yeah, I guess I'm agnostic, but I am not excited. Yeah, I don't think that 4 or 5% compensates people for the risk of $2 trillion deficits and malinvestment having all over the place. So we no longer dislike bonds, but the stocks we own we're excited about. Bonds would have to yield a lot more to get us excited.
Okay. Thank you again. I appreciate you being so transparent. It's wonderful. Okay, so here's my big question, and I understand that this is not at the forefront of your team's mind, given that you're so bottoms up focused. But going back to Cantillon's River, right? We have you can make a pretty good argument that what reversed financial asset prices at the end of 2022 was liquidity. And I don't know if you're familiar with the work of Michael Howell, former Salomon Brothers, one of the guys who cut his teeth there. His big focus is liquidity, and he publishes a lot of analysis, regular analysis on it. And basically, his models show that liquidity goes in cycles, cycles of net expansion, net contraction. These are multi-year cycles. He was one of the guys at the exceptions at the end of 2022. He flipped bullish, and the reason why he did was because the capital flow cycle flipped from negative to positive, and he's remained bullish ever since. And kudos to him. That's how things have played out.
Yeah.
His cycles have this current cycle peaking at the end of this year. Right. So he believes that liquidity will continue to increase this year, but at a slower rate. So he thinks that its upward pressure on asset prices is going to diminish as we go through this year. And then as it switches to negative, he's got a pretty negative outlook for the year plus, following the end of this year. One thing that it's got him concerned is, so he might be right, he might be wrong. I'm not asking you to buy into his model per se. But that's one argument, that liquidity flows, are going to start to diminish. Now, the thing that he's most focused on this year as a worry is the corporate debt refinancing wall that we're hitting, where all this low cost debt that's on corporate America's balance sheet is now increasingly having to re-rate at prices that are like, costs that are like 2x, what was on the sheets before, balance sheets before. So that acts as like a further liquidity sponge going on, right? Then you throw in the mix, we've got these 2 trillion deficits you're talking about. I think it's not bad odds that U.S. might continue to still spend at that rate going forward. But titularly, we have DOGE, the new Department of Government Efficiency. We have this at least stated desire to try to contain government spending more going forward. And obviously that, if it were to be enacted even partially, would diminish Cantillon's River of liquidity as well. So how much of a concern, focus on your end is liquidity going forward? And do you have any particular thoughts to the things I mentioned that could affect it in 2025, or anything else that you look at around liquidity?
Sure. I mean, it's all very interesting. And wouldn't disagree with any of that. We tend to be very long-term and simplistic about it. So to us, there's X supply of dollars. If you had double the supply of dollars, the dollars are worth half of what they were. That's just a fact. Yeah.
Mm-hmm.
And but as Canelon points out, prices of everything aren't going to double tomorrow. And so it's sloshing down. And sounds like he's looking at it as, when does the river hit and when does the wave subside?
Mm-hmm.
Where we kind of say, well, since 2008, the money supply is up 8 times, something like that. And so if you're going to buy the NASDAQ, which is up 10 times, I think, since then I need to be very worried about whether that wave starts to subside, because it's riding high. And if that wave crashes, it crashes down. And so you need to be very concerned. And if you're talking the US market, it's just up 8 times. You can worry a little bit about there too. But we're talking about markets like the Chinese market is lower than it was in 2007 before all this money supply, despite the fact their economy's grown 6 times. The Korean market, typically grows, has done pretty well, and it's not very much from where it was many, many years ago. Emerging markets in general have done next to nothing. Commodities, are they riding high on the rise? I already mentioned uranium is half the price it was back in, I think it was 2007, and oil is, half price of its peak, and silver is, I think, 40% down from its peak, and so on. And so we're buying companies and stock markets and materials that people need, and we're buying things that have not yet caught that wave. And so I think his work sounds important to people that are riding that US tidal wave. And for us, when that tidal wave crashes and wipes out the stuff there, but finally rolls over to the next country and gives us a ride, we're playing the things that have not even recognized that the water's coming. Yeah. And so we I think have a completely different focus. And then on that note, if you double money, all right, prices of stuff should go up. What should go up? Things that are scarce. So money's not scarce. They print it now.
Right.
The thing, there's an extra trillion. But things that aren't scarce, there's no need for them to go up, really. They can make them as fast as they make dollars. But it's hard to create out of thin air another railroad or another Cellcom, cellular infrastructure, or more farmland, or create more of copper that's needed for EVs and windmills. How do you create that out of nothing, or gold? And so I think it's important that people focus more on, I guess, with the analogy, stuff that's going to float when the water comes versus stuff that won't. And so we would agree with them, but we just think that that's more of a U.S. focus, and we think eventually the bull market's headed elsewhere.
Got it. Yeah. So a much bigger worry for those who are long the S&P or invested in the Mag 7 stocks.
Yeah.
Maybe less of a worry and even more of an opportunity for somebody with your firm's approach. All right, Dave. Well, look, I can't thank you enough. This has been a fantastic discussion. I wish you all the best with your strategy here in 2025. For folks that have really enjoyed this discussion, maybe weren't familiar with you and Kopernik's work beforehand, if they'd like to follow you and your work in between now and your next appearance on this channel, I hope I can get you to come back. I hope you've had a good enough time that you will. Where should they go?
They can look at our website, kopernikglobal.com, and also send us a message. We'll put you on the list and would love to talk to anybody.
All right, fantastic. And Dave, when I edit this, I'll put up the link to Kopernik Capital there on the screen. Folks will also have the link in the description below this video, so you can get there with one click. Dave, stick around for 1 sec here. I just have like 30 seconds worth of housekeeping, and then I want to give you the last word.
Sure.
Folks, if you've enjoyed having Dave join us here, please let him know that, and you'd like to see him come back on as soon as the schedule allows by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Definitely, if you like Dave's approach, go check out Kopernik's website and have a conversation with Dave and his team there. But if you've got questions about how to navigate this potential road ahead, especially given the lens that Dave looks through, highly recommend you have that discussion with your professional financial advisor. If you don't have one, if you don't have a good one who's playing the role as a good guide and financial quarterback for you, but would like to talk to one that understands all these macro issues, feel free to talk to one of the ones that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. These consultations are totally free. There's no commitment to work with these firms. It's just a free public service they offer to try to help as many people as they can. All right, Dave, thanks so much for waiting. So most of the people who are watching this channel, we do have some institutional professionals who watch, but it's mostly regular retail investors who have been working hard to build wealth for their families, and they'd love to prudently grow that wealth. But more importantly, they don't want to lose it, especially if some of these risks that we've talked about to the markets actually manifest here. What parting bits of advice would you have for them?
Okay, no, that's a very good question. Preservation of capital is always important, but it's especially important when markets are frothy and high and everybody's excited. So diversification, we think, is important. So if the US is now 75% of most people's portfolio, that's pretty concentrated and expensive. Right now, international relative to US is the cheapest it's ever been. Growth is about as expensive relative to value as it's ever been. Real assets are, I think, as cheap relative to as they've ever been. And so I think right now, time to own some real assets in your portfolio, some international stocks in your portfolio, some small stocks in your portfolio, some value, and diversify. I don't think you want to have all your money in one country or in one style, especially if it's momentum right now. So good time to think about moving at least a little into some of the things that haven't gotten so exciting.
Very well said, Dave. All right. Well, look, I've got to give Stephanie a huge thank you. And I just want to bring this up in my last recording with her, which is just a couple of days ago. We were doing a live Q&A with the audience, and one of the people asked her for some book recommendations. And she gave a financial-oriented book, but then she just said, well, look, one of my favorite books of all time was Atlas Shrugged. And I see on your bookshelf above you, you have three books. One of them is The Fountainhead, which was Ayn Rand's sort of precursor, if you will, to Atlas Shrugged. So I'm assuming you're a kindred spirit there with Stephanie. I actually I have a daughter who just went off to college, and I sent her off with a copy of The Fountainhead. I don't know if she's read it yet, but I've got my fingers crossed at some point I'll hear from her.
Yeah. Oh, the name like Taggart, you can be Atlas Shrugged. It's
how can you not exactly be fans of these books with a name like mine?
yeah, I like
right.
Fountainhead and Atlas Shrugged were both great books in my opinion, and probably apropos again in the in the world we're living in.
And yeah, maybe it's funny. I mean, every time I reread it every couple of years, and I'm always amazed at how timely it still is. But to your point, I think it's probably more timely now than it's been in the past couple of decades.
Yeah.
All right. Well, Dave, look, this has been an absolute pleasure. Thank you so much, and really look forward to having you back on here again in 2025.
My pleasure. Thank you.
All right, everybody else, thanks so much for watching.